This is episode 259 of Zen and the Art of Real Estate Investing with my guest, Brad Johnson. Brad is the co-founder and CIO of Vintage Capital. He has 20 years of experience in both traditional and alternative asset classes. He has background experience in real estate, investment, private equity firms, and over his career has closed over $3.3 billion in commercial real estate acquisitions. Brad, welcome to the show.
Thanks, Jonathan. Thanks for having me.
Yeah, I'm excited to talk to you and talk a little alternative assets and your career. Do you remember the first time you were really interested in real estate?
Yeah, I was probably 24 or 5, and I had a startup where we were making some money, and it was in the shipping industry. We were consultants. Basically, we'd go into shippers and renegotiate their contracts with UPS and FedEx. And I was nervous that one day UPS and FedEx would just destroy our business and say, you can no longer work with these guys. And so we didn't really have any moat or anything in our business. So we started taking our profits and investing it in just single family rentals in markets that we really liked.
Yeah.
So Nashville, Las Vegas, Palm Springs, Austin, Texas. And so, we could go, my buddies and I could go to these cities and it'd be a good excuse to visit the nightlife.
Yeah.
It wasn't a great thesis for real estate, but it
worked.
I
don't think it's that way, because when I started investing in short-term rentals so long ago, my sister and I would buy places where we wanted to go. So we just have a free vacation home. I mean, it's the luxury of having the resources, but I find it to be pretty smart investing, because then you really get to know the areas. And like you said, you have an extra reason to go.
Yeah, it was nice. And we're like, we can deduct the trip, the flight out there too. And so, I mean, it was fun. I'm glad we did it, but that definitely, I got the bug at that point, and that was the catalyst for me exiting that partnership, that business, and going off into more institutional real estate.
What led you to go and say, hey, mobile home parks maybe is going to be the thing that interests me? What led to that year of research?
Yeah. Well, so I think that's the best thing you could do is really just try to pick things that are like good businesses or good real estate assets that have tailwinds.
Yeah,
and then like a lot of it's out of your hands, but that at least you can control is upfront. And for mobile home parks, it was really, I was working in real estate investment banking, and I was looking at the loan tapes on a giant portfolio of loans. And I kept seeing manufactured housing in these loan pools, and they had the highest yielding debt yields.
Yeah.
And yet they had the lowest default rates. Right. So those two things should be opposite, right?
Yeah, right.
We should have, if it's higher returns, it should be higher risk. So that got my attention. And that was really the catalyst for me going off on my own. Cause I was working insane hours in banking. It was a great experience, but I wanted to do something that was my own. And a lot of real estate people have this feeling too. They want to go out there, control the assets, and build a portfolio and drive returns and get the tax benefits and all that good stuff that we all know. And so that was really, when I made that leap and started buying parks and got up to 23 assets nationwide as an operator, 2,300 pads. And it was a great run. When the math started not making sense on new acquisitions in like 2020 around COVID and 21, sold that portfolio, which ended up being good timing. Was probably a little more luck than skill, but the math wasn't as compelling as when I started in 2013.
Yeah. A couple of questions. When you first got, I mean, I think it's interesting that you saw the numbers on mobile home parks and realized that they were great, but did you have to fight the stereotype of mobile home parks? Because I've done a few mobile home park show, and everybody always says, oh, well, there's a connotation to mobile home parks it's not real. Like anyone who operates mobile home parks knows they're basically ATMs if you do them correctly, but there's still this kind of overarching persona that everything's a trailer park. It's going to be impossible. Like all people who you don't want to manage are going to be there. It's not the case, but did you have to fight any of that, or were you so focused on these numbers work? So let's go.
For sure. Like there are people that invest in this space that do buy those types of parks that you would not want to drive through in the middle of the night. Right.
Yeah.
I've always just avoided those parks, right? I think of this more as, it's affordable housing. Properties that are safe and clean. And we have a affordable housing crisis in this country. And yeah, sure. When you're, looking at a park in a remote market that's rough and it's a 10 cap, there are people in the space that think of these things as cash cows. That's the wrong way to think about this
Yeah, yeah,
industry.
yeah,
This industry, you need to come with a lot of capital and professional management to really improve these assets, because what you're offering is extreme value. The demand is not a question in this market, right? There's limitless demand for
yeah.
affordable housing. It's really, do you have the capital and expertise to run these things the right way, is more of the, I think that the thing that people don't really appreciate about this asset class. And there's just a spectrum of mobile home parks, right? There are a one-star park is, a trailer park, right?
Yeah, yeah.
Where it's not pretty, right? But that's a tiny fraction of the parks out there. And certainly out of the 50,000 that exist, you know, you probably only are going to want to buy, 10,000 that are what I would call a 3-star or above. And those are very nice properties
Yeah.
that will go up to like a 55 plus senior, looks like an asset that, it could go on a trophy, front page of somebody's, investment portfolio marketing materials. They look like the Florida, bocce ball court,
Yeah.
pickleball, right on the water. So it's a spectrum, but they all are mobile home parks technically.
When you're starting, you have no relationship, so nobody knows you as, "Hey, you're a closer, we know you're gonna close." You're literally just like anyone, so you really have no extra cachet, which I'm sure you have now, them knowing that you've operated and closed on so many.
Yeah.
It's a much different thing, but it takes a while to build that up.
Yeah, no, it's a weapon. Your reputation in this industry is an absolute tool to go out and buy more deals and drive returns. Because, and I often found that where it comes in a lot is when there's a deal where you came in maybe second out of 4 or 5
Yeah.
deals. Because a lot of brokers won't do like a broad listing. They don't want to talk to
Right.
30 yahoos who read the thesis on mobile home park and want to jump in,
Yeah.
right? They want to talk to people that they know are going to close, which is why it's hard to break in initially,
Yeah.
which we can talk about. But so oftentimes we'd have something where we'd submit a bid on a pocket listing and we'd come in second or third. And because we'd done multiple deals with that broker before, if the deal fell out of contract because somebody was
Even
reaching,
if it, like, smells a little funny,
yeah,
you're gonna get the call. That's
you
why
get
I
the
love being the backup. Yeah.
yeah,
Yeah.
it's my favorite place to be. It's
Me
like
too.
that talking horse because generally speaking, it becomes uneconomic, right? It's like that broker knows he only has one more bite of the apple, right?
Yeah, and yeah, right, you have leverage. They don't, especially if it went public. I mean, went public, they're
Yeah,
done. Like, you can't mess that up. But even in that little core structure of the 4 or 5 people who have access, they're just ranking, "Hey, who's a better closer?" Yeah, I love it. Backup's a great place to be. And it takes the pressure off. "Hey, we lost. Cool, no problem." And then you get a call 2 weeks later, "Oh, I don't know, I'm looking at some other parks." I always have leverage to get a little bit of a better deal because now you're helping them.
yeah, totally. Yeah, I always felt like it's winning a deal is always, you close the deal and you go to this closing dinner with the broker and you're always like, why am I celebrating? I just paid the most money. The stalking horse great is a reputational. I put that in the alpha category of reputation. So when you're starting out, it's so hard to get to that point.
Yeah,
But what I found was useful is I literally had an email list for the brokers where I would be treating them on like investors, prospective investors, where
yeah.
I'm reaching out to them once a month, like telling them, what we're focused on, where we're looking, just reminding them that we're not just fly by night people trying to buy something off LoopNet, is that we're really committed to this. And then, you kind of create your own luck that way. A deal fell out of contract and the guy was like, oh, I know Brad said he specifically wanted this market.
All those people who thought they were buying amazing in 2020 or 2021, and now that 5-year rate is up, and oops, they are factoring in that they were only going to go from 3 to 4.5, and now it's 7. Big difference.
Huge difference. And that's all like when you have a short-term hold and it's not, and most of these assets aren't kicking off a ton of cash flow. I mean, in most of real estate, I'm saying,
Yeah,
right? So then it becomes literally your 80% of your IRR is the exit assumptions.
yeah,
So I don't like that kind of like execution risk. I like let's buy good businesses that generate a lot of cash fairly reliably, put conservative debt on them, and hold them indefinitely. And part of that is tax driven, right? Because a private equity firm is generally funded by an endowment, a pension fund, non-taxable, right?
Yeah.
They're 100% IRR driven, whereas, and not even accounting for tax. But with the bonus depreciation that we get in this space and the accelerated depreciation,
Yeah, it's
even if you
huge.
don't bonus it, there's no taxes for a very long time. So why would I want to do that and then 3 years sell it when it took so long to buy the thing in the first place? There's not that many of them. We would much rather hold these things for the very long term, just to be able to really take advantage of those tax benefits and the cash flow.